I think you can see how genuine he is and the warmth he has for people that he knows. He really knows almost everybody by name. He's just a terrific guy. I'm proud to be associated with him, and so I welcome him to the stage, and I hope you welcome him. Don Wenner, DLP Capital Partners.
One more round of applause for Gunther, please. All right, so as we get started, dinner will be coming out here. Please eat as we move forward. You're also welcome to get up and go to the bar as well as I present here. I'm going to give you a little overview on what we do, how we do it, the investment opportunities, our new $1 billion housing fund. Then we'll open it up to questions for everybody here, answer any question you have. And then I'll be around, Larry, Rich, Bob, Mike. We're all around here to answer questions here tonight as well. As Larry said, we want to thank ArtsQuest, and we're going to circulate a survey here petitioning ArtsQuest to move some dates around so we can do our next event here as well, as we're working to make that happen. But in all seriousness, great turnout here. Thank you so much for coming. This is our biggest event ever, over 400 people here in the room tonight, which is really exciting. So with that said, let's get a pulse of the room here. So first I'm going to ask DLP existing investors to please stand up. So a round of applause for all of them, please. It's just so weird how they ended up at the same tables with the prospective investors. It's just amazing how that worked out tonight. So please make sure you chat with them. As much as I'm going to try to deliver a great presentation here tonight and give you a lot of information and insight on what we do, they're going to do an even better job of telling you how it works for them. Second, I would like to ask DLP team members to please stand up. They're up at the top and down here. Yes, so please give them a round of applause. We have over 50 DLP team members here in the room tonight. I always say this, but it really is true. I get to stand up here and deliver the speeches and take lots of credit from many of you, but it's all of these great team members who drive the results every day. We have 350 team members doing some pretty amazing things, as you'll hear about tonight. And then lastly, let's give a warm welcome to all the prospectivists. If you're not yet an investor of ours, please stand up, and let's all encourage them because they're going to be making their first investments tonight. Oh, I'm just kidding. A round of applause for them. Awesome. Thank you, everybody. All right, so let's go ahead and get started. You're going to see tonight there's some little pieces of paper there in the middle of the tables. Make sure you grab a hold of those. Those are for a raffle we're going to be doing. And winners of this raffle are going to get a weekend getaway to any of our vacation properties, which are in St. Augustine, Florida, St. Simons Island, Georgia, and Asheville, North Carolina. So we have beachfront houses, beachfront condos, golf course resorts, downtown Asheville. If you haven't been there, just an incredible place. We'll actually be doing an event there next week. So we're going to be asking a few questions here. We're going to tell you what those questions are now, and then you're going to fill out those answers on your raffle, and we'll collect them. They're going to go in these big bins next to me, and we're going to be giving out 2 winners, one an existing investor and one for a prospective investor. So the rules are up there, but you got to fill it out, answer the questions, and then we'll collect those from you later in the evening, and we'll be giving out 2 vacations. Who here, one last chance, raise your hand or stand up if you stayed at a DLP vacation property. Look at all these people who've stayed at these. So these really exist. We really send people to great vacations. So go out and enjoy them. We're excited to give out two tonight. All right, so the 5 questions we're going to be asking is, how big is this new flagship housing fund? How many people do we provide housing to here at DLP? How many years in a row have we been one of the 5,000 fastest growing companies in America? How many of our investors have lost any money with us? 4 questions, I guess. So sorry, we made it easier for you. Only 4 questions. All right, so why should you be interested in investing with us? I just want to start off here, lay a little groundwork to why you're here tonight, other than the great environment and good dinner and drinks and some time chatting with some great people. So first, if any of these situations apply to you, you have a family and you want to provide security to your family now and in the future. Yeah, you can check them all, as I'm hearing over there by a few. You are in retirement and want consistent, stable income, cash flow. You're planning for retirement and want consistent investment growth, so you have the nest egg you need when you retire. You have concerns with the future of the economy, and you want to protect your investments from the potential market correction coming. You like to have a good night's sleep. And maybe the one that I think really, if we're, probably a lot of people are honest here, maybe one of the biggest ones I think for a lot of people in the room here today, is you have people you want to help. So you have kids, grandkids, extended family, people in your community, people in your church that you really want to help, and you want to have the means to be able to do so and affect other people's lives. And I know that's been one of the most rewarding things of what we've been able to do, is hearing so many of the stories of what our returns have helped many people do for causes and individuals that are important to each of you. So a couple other reasons why you might be interested. If we want to talk specific numbers here to why you might be interested in what we're talking about tonight, you're interested in having fixed returns ranging from 6 to actually 10% fixed returns with monthly distributions, or you're interested in investing as an equity investor in our funds and earning over an 11% return on your investment. And lastly here, why you might be interested in investing with us is what your investment actually does for others above and beyond those you already know. So what we do with DLP here, all the money that everybody invests with us, the $133 million that the people in this room invested with us in the past year alone, all goes into this, into us making impact investments. And what I mean by that is we're making investments that, yes, they provide you as investors great returns on your money, but they also provide people such as Rocco, who's, where are you at, Rocco? In the back here. Yes, give him a round of applause. So Rocco is our local partner, one of our best borrowers and friends. People like Rocco, who goes out there and buys distressed homes, improves neighborhoods, is building a company, providing jobs to people, in addition to some really great nonprofit cool things he does, and a lot of our great investors do. We have Alex. Where's Alex at here? Alex, back here. Another one of our very close investors in back of the room here. Same thing, he owns, 7,000 single-family homes that he's renovating, all for workforce housing all over the country. We provide him capital to do. And then, lastly is the people ultimately. So we're providing capital directly into communities that we buy, renovating, providing safe, affordable housing. We're providing that money to investors such as Alex and Rocco for them to do the same thing. So there's a lot of value, a lot of people that get affected, and we're able to benefit, and communities are able to improve through the investment each and every one of us makes here who's invested with DLP, since it's really at the center of what we do is providing safe and affordable housing for rent, for sale, and supporting a lot of communities by doing so. And really that's the best way to sum up DLP. So a lot of people looking at DLP, hearing about us, looking through these brochures. If you go on our website, it looks like we do a whole lot of things. We got all these different companies you're going to see, all these different businesses. At the end of the day, everything we do revolves around providing safe and affordable housing. We do it directly, providing housing to more than 20,000 people. It's not a question on your sheet there. And by supporting over 100 other entrepreneurs doing the same things in many communities here locally and around the country. So, quick bit about us. So I'm going to tell you an interesting story here of how DLP started. So some of you have been here a while know I try to mix up and give you guys some different stories at these dinners. And this building here looks like kind of a cute building. And Rocco, don't let me insult this building here. That'll make sense to the rest of you in a minute. So this was DLP's world headquarters 10 years ago. And our world headquarters was not even as impressive as that picture shows you, because our world headquarters was the second floor on the left side of that picture. So literally 10 years ago, I went out and launched DLP, left. I was at Keller Williams at the time, left and launched DLP Realty and rented that second floor on the left side of the building on 14th or 15th and Hamilton Street for $1,400 a month, utilities included. And that was a big investment. And that's how we launched. That was literally our world headquarters. And literally All of our furniture came for free from a law firm that was getting rid of their old furniture. Our employees moved everything ourselves and set up the office and painted it. And that was our world headquarters, 10 years ago. And what kind of makes this story interesting is, so we were in that building for maybe 2 years, and then we moved to the building we were at for 7 or 8 years at 701 West Broad Street in Bethlehem. And a few years later, we bought the right side of the building, and we came in and renovated it. And then we actually ended up selling the right side of the building to Rocco in the back of the room there. And then he went and bought our world headquarters, the left side of the building. So now Rocco owns both sides of that building. I don't know if he has any space available for lease. He'll be sure to let you know if you're interested in setting up your world headquarters. But it just shows the full cycle of how DLP has come to be. And we provided the loan for Rocco to buy, this building, many years later. And that's where DLP started. And we've grown through a lot of hard work by a lot of people focused on providing housing solutions. The parent entity today is DLP Real Estate Capital. That's the umbrella entity around all the DLP businesses. DLP Realty here locally is the most well-known company. That's what we've been doing known as DLP Realty the past 10 years, having sold over 10,000 homes in the valley over that time. DLP Capital Partners is the company offering these investment returns. Direct Lending Partners is a company that Alex and Rocco and our borrowers come to borrow capital. DLP Real Estate Management does all the property management and construction management and asset management of our properties. Bright Homes is our home builder, building the most cost-effective homes to own, brand new homes that are net zero, have no energy bill throughout Florida. And then we have a title company, Alliance Property Transfer, and a loan servicing all of our loans called Alliance Servicing. So all of those companies, what they have in common is, or how they sort of work together, is they're all vertically integrated. So all these companies work together in providing these housing solutions. They all work hand in hand with each other. By having this vertically integrated set of companies working together for the same goals, we've been able to have some pretty great results, including 0 principal losses to investors ever, and exceeding our investment returns on all of our funds in every period since any fund has ever been open. And again, that's not a question on your papers there. And how we do that is we have a focus here in our business of really discipline. Discipline's at the center of our business. We call it the 20-mile march here at DLP. We believe in growing and running businesses that have disciplined thought, disciplined strategy. You'll see a little bit of that in a little bit. Disciplined people and disciplined action. And by having this discipline at the center of our business, we've been able to achieve some really great results to our investors and some really great growth, including being one of the 5,000 fastest growing companies in America. And thank you. So as you can assume by the name, it's the 5,000 fastest growing companies in America, right? So that's an impressive honor considering there's millions of companies in America. And how you make this list is how fast you grow over a 3-year period of time. They measure that percent of growth. And we've made this list for 7, going on 8 straight years. We are the 5th fastest growing company in America out of any companies that have made this list 5 or more times ever, out of all companies in all industries. So thank you. And it directly correlates with the exact, the consistency in the returns we generate, the ability to mitigate risk, is this approach to growing really consistently. So on the outside, you say, wow, they're so big. Gunther just told you how, he met me, I was 21 years old as a kid that he was taking a risk on. I was just talking to an investor here that I sold his house when I was 22 or 23 years old. And, it looks like we've grown so big so fast. But it's been extremely consistent year after year because we have people putting forth a lot of great disciplined work day after day. We've been recognized by a lot of great awards for this focus, discipline, including we are the fastest growing company in the Lehigh Valley. We are one of the top workplaces in Lehigh Valley for the last 5 or 6 years. We've been the #1 workplace in the Lehigh Valley. We're one of the fastest growing companies in Florida as well. And a lot of other great awards, including we're one of the top 10 real estate sales teams in the country by the Wall Street Journal each of the last 7 years. So a lot of cool awards for the consistency in our success. This past year, to give you a perspective in numbers to our size today, we sold 2,089 properties last year. We now have over 825 investors who have their capital invested with us, including about 200 in the room here with us tonight. We have over 400 loans out to investors such as Rocco and Alex that we're providing capital to fuel their renovation and improvement of housing. We own over 10,000 homes and apartments today, over $850 million in assets. We do over $100 million in annual revenue. We provide housing to well over 20,000 people. 20,000 plus people live in our properties that we own with our investors, living in safe, affordable communities. We're supporting more than 200 entrepreneurs, providing them with capital to provide great housing in many neighborhoods. And we have over 350 DLP team members across the family of businesses today. We're driven by a purpose: dream, live, prosper, passionately creating prosperity through real estate. If you didn't know, DLP stands for Dream, Live, Prosper. We have 10 core values that drive our decisions: the types of people we hire, the types of investors we want to attract, the decisions we make, all driven by these core values, which we'd love to tell you more about and share with really why this is so important. And I think it's important you're trusting us with significant amount of your wealth, to understand what our values are and how we think and how we behave as an organization. So I told you a little bit about the company. I'll tell you a quick bit about myself, and then we'll get into the strategies here. So I founded the company 14 years ago. I was a college student at the time, a little bit before I met Gunther. And I started initially at Keller Williams Real Estate. I thought I was going to be a financial advisor all through college, and kind of stumbled into real estate, like I think most people end up in real estate. Since then, I've closed more than 14,000 real estate transactions, and just last month broke $3 billion in real estate transactions, including $1 billion in 2019 alone. Thank you. So we did $1 billion in 2019 alone. It took us 9 years to tally up to $1 billion, and we did that last year alone. We own over 10,000 apartments and homes with our investors right now. And some cool awards for the growth and success we've been able to have. My wife, unfortunately, is not here with us. They are my kids, but I'm looking at them right now on Facebook Live. Kyle has this video up, so if anybody's on Facebook, anybody else besides my wife and kids, hello, but they're watching on Facebook right now. They're in Florida at the moment. So my younger son on the left is Alex. He's 6 years old. And my older son on the right is Donnie. He's 7 years old. My wife, Carla, we're coming up on 10 years of marriage. So yes, give them a round of applause, please. I'm quickly become better known as coach than I think as the owner of DLP lately, as I'm a coach of football and basketball for my sons. And I founded the company, as mentioned a moment ago, but it is a family business. My wife now officially is going to step up as president of our foundation, which I'm pretty excited about. My mom and my stepmother and my sister are all over here. Why don't you guys stand up? And my brother Will and my other sister Leah, all there at the center of the table. So my mom's been in the company now for maybe 12 years. She's been working with us. Ken, now 2 years, my stepfather. He's in charge of payroll. My father has been in the company for about 10 or 11 years. He's an inside sales manager, as is my stepmother, Lisa. My brother Will worked for us multiple times when he was in high school and college, but now he runs his own successful business. But he is a large investor of ours, as he's been having a lot of success at only 26 years old. My sister Kate has worked for us, just came back second time to come in, work in our marketing department, helping out. And then Lily, unfortunately, has been too young yet, but soon enough she'll be in the company. So you guys can go ahead and sit down. But it is a family business. A lot of my wife's family in the company as well. I told some of that story last time, so I won't go into too much detail. Some of you heard some of the story of my family coming into the business in our last event. In addition to my family, we have some great leaders here throughout the organization. You see here on the screen. One of the things that's really cool is there's 24 or 25 leaders here in the organization, many of which have been with us a lot of years, such as Bob Peterson, our CFO, Barry DeGroot, our Chief Legal Counsel, Larry, who many of you know runs our all of our investor relations, Brian, VP of partnerships. But we have 10 executives who joined us in 2019 alone, as we've been building out the leadership. And no longer is there anybody can question and say, this is an organization focused on on Don, or what how do I do so much, or what happens if I'm not available? We have an incredible leadership team here driving results across the organization, many of which are in the room with us tonight, and hopefully get a chance to chat with some of them. Here specifically in our fund management business, these are the leaders here. So Bob Peterson, as I mentioned a moment ago, and Barry are our partners here in DLP Capital Partners. Rich Delgado, Managing Director here in front of me. Hopefully you get a chance to chat with Rich if you haven't already. Dominique Song, Managing Director and Senior Counsel, is the only one not here in the room with us tonight. And then Larry, who I think just about everybody knows, our Head of Investor Relations. And they're the ones really driving day-to-day results, giving you guys great service, of course, along with this incredible team who do an even better job of giving you incredible service. Lisa and Mandy and Julia. And then the most important ones, no offense to you ladies, are Joanna and Dan and Monica and Sam and Tyler, because they're the accountants who actually make sure the distributions get out to you every month and get you your statements and get paid every month. So they're the most important. But really incredible team driving results. And then let's give everybody them, as well as our great marketing team and IT team who put on so far a seamless event here. So let's give them a quick round of applause for putting this event on for us tonight. So we started the firm, as of course most of you I believe know, here in Lehigh Valley, where I grew up. We're still headquartered right in Bethlehem, 95 Highland Street, across from Wegmans on 512. That's our now worldwide headquarters. We also have a southeast headquarters in St. Augustine, Florida, a little bit south of Jacksonville if you've never been there, oldest city in America. We have offices, which is our Bright Homes headquarters in Orlando, Florida. We have a new office in Asheville, North Carolina, where we'll be hosting an event next week. And then we have a couple satellite offices in Daytona Beach, in St. Augustine Beach, and up in the Poconos as well. We're in 34 states, but we are very heavy in the East Coast, Pennsylvania, New Jersey, and the Southeast. These little markers here show you where we own apartment communities, and in turn, where we also have team members, employees, in all of these locations. We're as far west now as Arizona and Utah, but again, you can see we're heavy here in Pennsylvania and in the Southeast. So what we do at DLP, all these people I showed you, all the companies, all these stats, is pretty simple. We invest in people and in real estate, and I think it's really important for you as investors to recognize when we say we're meaning, us as DLP, but all of our investors. That's what we're investing in, people and real estate. And in the past year, as I said a moment ago, we did over $1 billion in transactions, including more than $600 million invested into housing this past year alone. Invested into people, the team members here that we've hired, the families we support, the investors we've provided capital to, and then directly into apartment communities just in the last year, which is pretty amazing. The results, again, we provide housing to more than 20,000 people, 350 team members, 200 entrepreneurs we're funding, and in turn generating great returns to our investors. Here's some pictures of some of the things we do. That picture in the bottom right is an apartment community, actually the one we own in Arizona we bought a few months ago. That top left is one of our net zero homes that we build in Florida. And then you see some of our great team members and clients there as well. All right, so enough about DLP. Let's get into the investment. So first I'm going to tell you about, for many of you hearing for the first time, the DLP Housing Fund. This is our newest investment fund. It is in total our 8th fund we've launched since we launched our first fund 8 years ago. This fund is what's called an evergreen REIT. What evergreen means is it goes on indefinitely. We don't have an end date. We're going to keep running this fund as long as it makes sense to run it. It has the tax shelter benefits of owning real estate. It has the liquidity benefits of our lending strategies. And I told this to our existing investors in the happy hour, but we've run 2 types of investment funds. And if you look through any of our literature in the past, you've seen we've had 2 types of funds. We've had funds that make loans to real estate investors, which is part of what we do. And we have had funds that buy real estate and operate real estate. And there's always been 2 separate types of funds that we run. And if you invested in our lending funds, you got the benefit of monthly distributions and great liquidity. If you invest in our equity funds, you got higher returns and you got tax shelters of depreciation. This is our first fund we've ever opened that does everything in one fund. So it invests in everything DLP does, everything we're talking about here tonight in one fund. It makes loans to investors like Alex and Rocco. It invests in owning real estate like the apartment communities I just showed you. Everything DLP does in one fund structure, giving you all the benefits of our lending strategy and our equity strategies within one fund. Monthly distributions, annual liquidity, depreciation, and high returns. So from the quick stats here, the fund has a target overall return of generating at least a 12% net return to investors. And we've exceeded our return targets in all of our funds. The fund pays out a monthly distribution of the preferred return. So we're going to pay out a 0.5% dividend every month, which is 6% a year. That dividend gets paid out to our investors is before we even earn a management fee. So if you went and looked at 100 different investment funds, I would be shocked if you found one other fund, unless you're looking at one of our other funds, that the management fee is not paid until investors get a preferred return first, making sure we're always paying our investors every month. Then we earn a 1.5% management fee after we pay you a preferred return, and then you get 80% of all the profits we earn, we get 20%. This is going to be a $1 billion fund. It's going to take time for us to grow to that size. Today is between $40 and $50 million already. Already owns over 3,000 apartments. We seeded this fund with one of our existing funds of over $3,000 worth of apartments for over $200 million worth of properties already. I think one of the other things that's important, and this is the case with all of our funds, but we're not here pitching you guys and buying you all dinner to tell you this is what we want you to go do. We're selling you on this investment fund, and then we're going and putting our money somewhere else. We put in a significant amount of the capital into our investments. In fact, right now in our real estate portfolio, we as management have over 42% ownership in our portfolio. So our investors own 58%, we own 42%. In this fund, we are going to invest a minimum of 5% of all the capital that investors put in. So we will always be the largest investor in this strategy. Today, we already have, in the first seeding of this fund, we're about 35% of the capital today. So we're investing heavily right in this strategy, right with our investors. And I'll recap this again later, but that's the quick stats. And let me tell you what the fund does. So we make real estate loans, as I've been talking about, and we buy real estate. So we make debt investment loans and equity investments all in one fund. So in order to make an investment, we do two different sides of our investments, but it's investing in housing. And I believe if you're thinking about making any type of investment, whether it be real estate, whether it be the stock market, no matter what you're thinking about investing in, there's two things that are really, really important. One is it's a good strategy. Does it make sense? Does it make sense for the next year, or 3 years, or 5 years, or however long you're planning to be invested? And then does the management team execute really well? Any company, even if you're talking, big, large companies like a Facebook, it comes down to great execution. In every industry, most companies don't do that well, and there's a few that do really, really well. So you need great execution and a good investment strategy. I talked to you already about us as an investment manager already, how we're vertically integrated, all our team members, our businesses, all the things we've done to mitigate risk, have no losses, and exceed returns. Let me talk to you about the actual strategy here. So first, let's start off here, get some more participation. So raise your hand if you like to lose money. All right, good. If you can't read this, it says, this is little Susie. Little Susie is playing the stock market and not investing wisely. Oop, there goes little Susie investment out the window. Don't be little Susie. So we're really focused. We believe the best way to make money is not to lose money. Again, I've said this twice already tonight, but it's worth saying again. We've had zero losses to investors. That's the first principle of how we make investments. Yes, 12% returns sound really exciting. They sound really great. But first and foremost is no losses. Second is generating double-digit returns to our investors. And then we want to exceed our return targets. But that's the third goal. So again, do not lose money ever is rule one. Number two, consistent returns with monthly distributions. And then we get the best return we can without risking loss. This is our historical return. So if you take all of our funds and combine them over our history here since our first fund, what our returns have been. And some of these returns don't even calculate the fact that we're only showing the returns we've realized and distributed. Meaning if we bought real estate last year, 2 years ago, 3 years, and we haven't sold it yet, we haven't realized those profits yet, so we're not even reporting them yet. We're only reporting what we've distributed so far. And that's why you see, if you look back further, the returns are the highest because we've sold most of those properties. 20%, 21%, 15%, 13%, 12.5%, and last year 13.82% net return to investors. That's after our fees, net in your pocket, distributed to you. So what do we do? How do we do that? Again, first we make loans to real estate investors. When we say we make loans to investors, keep in mind, we're not lending money to homeowners. This isn't lending to a first-time home buyer. This is lending to experienced investors. We're making short-term loans, 6 to 12-month loans for somebody to buy a property, improve it, and then either sell it or refinance it into a permanent loan. First position, recorded mortgages, and they're always good news loans. So sometimes people, if you have some experience in real estate, may say, oh, so you're doing hard money lending. Hard money lending often has the connotation, it's often the case where you're lending expecting there's a good chance you're going to end up owning that property. You're lending because somebody's in desperation. You know, they desperately need money to pay a tax bill because they're going to lose the property. They're in desperation. We're lending to people who are buying a property to invest money in it and make a profit. It's a good news situation. We're lending mainly against houses and apartment communities. The same things that we invest in directly are the same types of properties we lend on. And you know, we started off as a real estate investor, and that's a unique point worth making. You know, most people who lend money are bankers, and they come from Wall Street, they come from, you know, financial institutions and decide, hey, we can make really good returns lending money to real estate investors. And you know, that's how, you know, we came to become a lender. Is actually we worked with lenders just like ourselves today. So back when we were flipping, you know, hundreds of houses, and we still do tons of them today, we were needing lenders, private lenders who could work with us on buying properties really quickly and renovating them and so forth. So, you know, back a few years ago, we were renovating tons of homes, renting them, flipping them, and we were working with other lenders such as ourselves. And what I realized is that most of these lenders knew nothing about flipping homes. They'd never done it. They didn't understand how renovations work. So they were very difficult to work with. They didn't really get it. And so it also means they couldn't really mitigate risk well because they didn't actually know how it worked. And we realized, you know, there's a great opportunity here. We understand this. We understand how construction works, property management, how to acquire. We can value properties. You know, we can sell them. We have great knowledge. And so really the first time I started working with the lenders, I realized, you know, that's something we need to do. Especially when I realized that I would do all the work. So I would find a property. People hear us on the radio as an example, want to sell mom's house. We'd come in, we'd buy it. We'd take the yellow carpets and the pink walls and, you know, the wallpaper and the shag carpets and, you know, all the old dated houses. We come in and we fully renovate these homes. We come in and we gut them and put in a new roof, a new heating system, a new kitchen, and new counters and new flooring and, you know, renovate it and landscape it and stage it. And, you know, we had staging warehouses and moving vans and huge staff. At one point we had 100 people just in our construction company. And we're doing all this work renovating these homes, and if we do everything well, which we did most of the time, you know, we made $20,000, $25,000, which that's nothing to sneeze at when you're doing it a lot of times every year. But I realized the lender who didn't do any of that work, really didn't take any of the risk, he was making nearly as much as I was. And I said, that's the side of the business I want to be on. So, and realized we could bring a lot of value. So we decided to become a lender. We launched Direct Lending Partners in 2014, really realizing we could bring a lot of value above and beyond money, but in knowledge and education and resources to other great operators, and launched Direct Lending Partners. This here, if you can't read it, it says, first time flipping houses, and says this is the type of person we do not lend to. Get it, the houses on the side? That was Kyle's joke. Kyle's in the back of the room if you didn't find it too funny. But in all seriousness, you know, who you lend to is pretty important. And, you know, said before, we don't lend to first-time home buyers, you know, such as, you know, FHA financing, lending them 100% of financing. We're lending to experienced real estate investors. We're not lending to the guy watching HGTV saying, hey, I'd really like to flip my first house. Our average borrower looks like this. So our average borrower today has over a 700 credit score. Our average borrower has a $3.5 million net worth. Our average borrower has over $500,000 of liquidity, generally cash. And our average borrower has completed more than 25 real estate investments. I mean, literally, you have a couple of the examples here in the room tonight who've done hundreds, if not thousands. So these are experienced borrowers who know what they're doing, who employ construction crews, who are buying good deals, who have the ability to actually execute. And then what's equally as important as lending to really good borrowers is how we leverage or what leverage we provide, or how much capital we provide. And the most important factor, if you were going to lend money to anybody, the most important factor in any type of lending is how much skin does that borrower have into the investment, whether it's real estate or anything. If you lend somebody 100% of the cost of something, they have no skin into it. Their risk is very low of what they would lose. Our average loan to cost is 73%, which means the borrower puts 27% of the purchase price plus all of the cost of renovation out of their pocket, plus the closing costs, plus the interest payments, plus the holding costs. And our average loan to value is 55%. So on average, there's 45% equity above our loan amount. So a lot of equity and a lot of skin in the game. Now, and existing investors, don't give this answer away here. So when people hear lending, I think if you're thinking from a risk perspective, you're thinking from a place of skepticism, your mind, some of us, our mind goes back to 10 years ago, 11 years ago in the great real estate recession, and think about all the mortgage foreclosures, right? Anybody's mind think about mortgage foreclosure when you think about lending money, right? So in the 2008 mortgage meltdown, there were more than 10 million homeowners who went into foreclosure. Okay? That's a lot of people, right? Take a guess. Existing investors, don't give the answer here. You can just shout it out. What percentage of those 10 million people who went into foreclosure put 20% down on the home? 1% I heard up here. 0. I think I heard 2%. 5. So all pretty good guesses. So it was less than 1%, less than 0.1% of people put 20% down. So if you were a lender, what would you think would be important, right, in making a loan? Skin in the game, right? And exactly what I just talked about. But today, you might think, oh, that was the mortgage meltdown of 2008. Today's world, things have gotten much different, especially at these 4% interest rates, right? Lenders wouldn't give 4% interest rates and give people, a high percentage of the purchase price, would they? Well, today, the average mortgage, take a guess at what the down payment is that the average person, first-time home buyer puts down on the home they buy. 10% I heard? 3%? 5%? 1%? So 3.5%. That's FHA financing. But it's not really 3.5% because you can roll all your closing costs for 6% of the purchase price into your mortgage. So if you take out 96.5% of the purchase price and add 6% closing costs, how much financing is that? 102.5% of the purchase price. So that's the type of lending that banks, that the government does today at 4% interest rate. Our average interest rate is 10.3%, with 27% the money invested by the borrower to people who with a $3.5 million net worth. A little bit different type of investing that we do. In addition, we're not making 30-year mortgages. We're making 6 to 12-month loans. Our average loan pays off in under 9 months. So we're not taking long-term risk to what happens if real estate values go down in 5 years or 10 years. We're making very short-term loans. And it also creates a lot of liquidity for you as investors because a third of our loans pay off every quarter, every 90 days. We're having to re-originate new loans. So it creates a lot of liquidity for you as an investor. Another way we mitigate risk in lending is through diversification. So if you made one loan to one borrower, if that one borrower, that one property has a problem, you can be in trouble. When you have over 400 loans out to over 100 different borrowers across 80 markets in more than 20 states, gives you a lot of diversification of all types of risk. Another way we mitigate risk is through DLP, the fact that we've flipped thousands of homes. We own 10,000 plus rentals. We own a construction company. We own a management company. We own a real estate brokerage. And we own and do all these things in most of the same markets we lend in. even though we have all this expertise and we know how to evaluate and value real estate really well, even though we have our own construction companies and great expertise in construction, we still go and hire a third-party appraisal, a third-party valuation to be done on almost every loan we do, who goes out and physically walks the property, inspects it, does a valuation report, gives us pictures. We get a third-party construction inspection firm to go out, inspect the property, give us a write-up, evaluate the work that needs to be done, and give us a whole report. And then we hold back all the money they need to renovate the home, and we release it to them only after the work's complete over a draw schedule, also helping us mitigate risk. So, question here, IT is going to handle this for me. So, do we lend to inexperienced investors? Is the question?
No, God! No, God, please, no! 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 No!
So again, we lend to experienced investors. All right, IT, I can't click now, so maybe you can help me here. Here we go. So here's a couple case studies of a couple examples. This is on the larger end in terms of the types of houses we lend on. Let me see here. Did I skip the before? Oh, there's other befores. Okay. So this was kind of just a dated but a high-end home. And as it says there, the client had a unique opportunity to grab this property. It's in Tampa Bay in a really high-end market. This client had a line of credit with us. We'd already lent them multiple loans before. They really felt this was, a really great property, but they needed to close really quick to get this deal. So we gave them a loan for $1 million. They'd already done over $5 million of loans with us, had done a lot of successful projects with us. They bought it for $955,000, put $235,000 into renovations. When we gave them the loan, it was valued at $1.45 million, is how much we valued it at when it was complete. So the loan was 61% loan to value based on a $1.45 million value. They actually sold it in under 4 days for $225,000 more than we valued it, $1.675 million. And here's some pictures of what it looked like at the end. They professionally staged it. I mean, real high-end, high-class renovation. And these guys are experts in doing these types of projects. Here's a kind of more normal type of property we lend on. This is a $208,000 renovation loan, $207,800. They came to us looking for a 6-month loan. We'd already done 16 loans for this borrower. We gave them a loan. The house looked like this at the beginning, and they came in here and cleaned it all up, put in those new flooring, new kitchen, new lighting. So again, here's what it looked like when they bought it. Here's what it looked like when they finished it. So really professional rehabbers. People know what they're doing. Loan was $207,000. Interest rate was 11.99%. 85% loan to value. That's the high end of what we do, but we had done a lot of deals with this borrower already. And they sold it for $380,000 for a $135,000 profit. Really did an amazing job. And our loan, again, was $207,000. Sold it for $385,000. Those are some examples of the types of loans we do. All right, so let's move to the properties we buy directly. So one of the benefits of us buying properties directly is tax shelter. We get the benefit of depreciation. We get to shelter our income from tax. So to talk a little bit about this, Larry is going to bring up Linda and tell you a little bit about her experience investing with us, experience investing in this strategy as well. So let's give Linda a little round of applause as we grab her.
There she is. All right. Thank you so much, Linda, for coming up and talking with us here. So the first question I have for you here is, how long have you been investing with us at DLP?
My husband and I have been investors since August of 2019.
Excellent. And so tell us a little bit more how you came to know us.
I met Bob Shimonek. I'm in the insurance and financial business, and I met Bob, and I wanted to talk to him about partnering with me to help my clients with their investments. And so we started looking at my portfolio. And he brought DLP to me, and we became investors in the Income and Growth Fund.
Thank you. And so in terms of, your investment in the Income and Growth Fund, what made you make that decision to go into that fund particularly?
Well, I think a lot of people here in the stock market experienced, since especially 2008, the Texas two-step of 2 steps forward, 2 steps back, getting nowhere fast. And for all of the investment risk that I know people have in the stock market, there had to be something better. And real estate made sense. And investing in middle-income America-style investment properties, real estate that middle income, the fabric of America, lives and resides in, made great sense.
Excellent. Awesome. And so in terms of, your experience with us and with DLP communication-wise, or, just how we've interacted, can you tell us a little bit more about that?
I love opening up my DLP statement online. Every month. I can remember there was a time when people didn't want to open their investor envelopes in the stock market. But I can't wait to click on the link, see what it did, e-file it, and think to myself, thank you. That was well done.
Excellent. Thank you for that. I enjoy that too. And so just to, finally, I know you've done a lot of work with Bob Shimonek, and you've brought DLP to your clients. Can you tell us a little bit more about what you say, and what would you say to folks who are considering investing with DLP?
One of the things I think is a common thread is the stock market. And while I believe that the stock market and America is heading in the right direction at this point, one of the things that's tangible that we can all identify with is real estate. We all live in homes. We all live somewhere. Most of us understand we've got to manage that real estate properly. So we've got that kind of tangible experience just personally from living in our own homes or our investment properties. And it just makes sense that the level of risk with the property management that DLP provides, as well as their purchasing strategies, their lending strategies, just as you've heard, it makes incredible sense. And with double-digit returns, last year in the Income and Growth Fund, 13.22%. Those are great numbers. I'll take that any time.
Awesome. And just so that you know, Linda does not work for DLP, but it would sound like it. If you ever want to come over and see us, that would be fantastic. But thank you so much for coming up and speaking, Linda.
Thank you,
Let's
Linda.
give her a big round of applause, please.
Thank you, Linda. And so she was mentioning the Income and Growth Fund. So the Income and Growth Fund is our lending strategy. We have 2 funds that do that, the DLP Lending Fund and the Income and Growth Fund. Both are available for investors. So the other side to our strategy, and both of these strategies, lending money and investing directly in real estate, are being done out of this new fund, the DLP Housing Fund, which I'm going to tell you a little bit about here now. So next participation here. Who likes paying income taxes? No, right? Nobody does, and it's a major challenge for us all to minimize the amount of money we have to give back to Uncle Sam, and that's one of the many reasons that people love investing directly in real estate. Love investing is the benefit of depreciation. So by investing directly in real estate, we get to depreciate our properties from a taxable standpoint, which helps us write off a lot of the actual cash we distribute and gains from paying taxes. And what we're doing specifically, predominantly, is investing in apartment communities, in addition to single-family homes, but mainly apartment communities. In other words, rental housing. We acquire it, we improve it, we manage it well, we stabilize it, and again, provide great housing and also, in turn, great cash flow, great returns. So why do we invest in rental housing, multifamily? Probably many of you know this, but the way I like to think about it today is America is a renter nation. That might sound strange to most of us, because most of us probably own our own home. But most of America is moving in the direction of rentership. In fact, 10% of Americans, which is about 20 million people, have gone from being homeowners to renters in the last decade. And one of the things that maybe you guys have heard before, but it's actually the baby boomer generation that's driving the rental growth the most. So yes, millennials are renting, and family formation is happening later in life, and home ownership is happening later in life. So people are staying renters longer, but also people, for the flexibility, are choosing to stay renters indefinitely. And then people who are already homeowners are choosing to trade in owning a home and maintenance to rent a place and not have to deal with it. So I believe strongly that this trend will continue for as far in the future as any of us can realistically see, and people will be choosing to rent over home ownership. Despite the fact that there's been this big demand on rentership, and in general, a big demand on housing, we've had a major lack of supply in housing in America. So this is hard to read these stats, but I'll help you look at this here. So this chart shows from 1968 to 2018. It shows how many million homes were built each year. And the kind of dotted line is about 1.2 million household units. And you'll see in the midst of all that green, there's one blue line. That's the 1 year from 1968 to 2008 that there were less than 1.2 million housing units built in America. Only 1 year ever. And that was 1983, I believe. 82, sorry. So that was the only year that happened. Since 2008, we haven't eclipsed 1.2 million housing units built. In 2008, we had the greatest oversupply of housing in America ever. Today, we have the greatest undersupply of housing in America ever. Think about that. Everything, real estate specifically, but everything is about supply and demand at the end of the day. What drives value, what drives pricing. We have the greatest undersupply of housing we've ever had. Something interesting is actually December of 2019 broke the record for the most home starts in 13 years. So finally, we're seeing construction start to catch up, but we're still having a major shortage of housing. Last year, about 400,000 housing units were built, lower than what the demand was, just last year alone, further creating this deficit. And what makes it even worse is that almost all of the housing that is being built, the 1.1 million or so housing units built last year, very little of it is affordable to most people. Most of the people, the workforce in America today, can't afford the housing that's being built, whether that's for sale or for rent. So there's a major, major epidemic in America today for affordable housing. The demand drastically exceeds supply in almost every market. Most specifically, in the place we do the largest amount of our investing is in the South, and heavily in the Southeast. Those states have the strongest population growth, have the strongest job growth, which creates the strongest demand. And that's not going to change. When we go into a recessionary environment, the demand for people who are going to be looking for that $800 a month apartment versus a $1,500 or $1,800 a month apartment is only going to increase. So we think it makes it a really safe place to be, even in a recessionary environment, because we're going to have high occupancy, our rents are going to remain strong because demand is going to be so high for affordable, safe places to live. We do a lot of our investing in what some people call secondary or tertiary markets, meaning smaller markets. And these smaller markets have an even bigger demand because the big developers and builders and investors don't go to these markets. And it also creates better investment opportunities because those same big investors and big developers aren't there trying to invest in those markets, which means there's less competition. So I'm not going to read all of this, but it gives you some bullet points, which we'll email this out in kind of our quarterly reports if you haven't already received them, went out a couple of days ago, that'll give you a lot of insight to what's going on in the real estate market. But the short story, despite hearing you'll hear lots of conflicting stuff if you're going on whatever, Facebook or any online website. You see all kind of conflicting reports or read different publications about where we're at in the real estate market. Heading into the start of this new decade, the real estate market, all the fundamentals are really, really strong. Demand is really high. Supply is extremely low. Almost every market at record low supplies. Occupancy is high on rental homes. Home prices are going up. Rent is going up. And that's what we expect to happen here in 2020. We're not expecting to see home prices go up 8-9% or rent go up 8-9% like it has in some of the past few years, but it's going to remain strong. We're going to see growth. It's a really, really stable, strong, fundamental market today. So to tell us a little bit more about investment strategy, we're going to mix it up here and play a short little video here from George, who is in the room with us here tonight. George, where are you? There he is. Over here? I don't see him. Where's he at here? Down the other way. There he is, all the way in the back. Hey, George. So go ahead and play this video from George.
George Miller's my name. I've done a whole lot of things in my lifetime. From I graduated college, I was active duty with the military as an Army officer overseas. Went to work for General Motors for 3 years, and then became a very, very young General Motors dealer. I'm born in northern New Jersey. I'm a graduate of Seton Hall University. First dealership was in Summit, New Jersey. We bought a couple in that general area. On the way, I bought one in Vermont. Always General Motors, though. I came to Pennsylvania in 1986, Oldsmobile Buick GMC truck dealer. DLP crossed with me name-wise when I was buying real estate. I'd buy house, fix it, sell it. Buy a house, fix it, sell it. Maybe rent it in between. And along the way, there was one that I wanted to sell prior to the winter. DLP appeared at the right time. Worked out a big deal, and I'm saying less than 2 weeks, it was gone. And from there, the relationship grew. I was impressed with what I saw, and it grew into, you need to be an investor, and I've been an investor for, I think I'm getting ready to go into my 4th year. So when you go into a business venture, you look at a couple things. One is the product. Is it any good? Does it have diversification possibilities? What's the plan? Short term, long term, you have built-in changes. Are you able to adjust with the market? Do you see opportunity? And the third thing is you need the people to execute the plan. And ultimately, the bottom line is the report card. Did you perform? Did we get the return on investment? Are you transparent? Did you mail me what you're supposed to mail me each month? And they've done an outstanding job for me over the 3.5 years that I've been with it. I've probably met Don 2 or 3 times. Of course, you see him at the meetings too, but my intent was to really quiz him, okay? Prove to me that you know what you're talking about. And I didn't throw him any softballs, I threw him some hard ones. And he's got a very, very good grasp of what his product is and what his plan is. So my impression was well-educated, smart, got his act together. My particular interest is in the Income and Growth Fund. I'm looking for ordinary income. There's a target, but it's always hit over the course of a year. I get paid some compounded, I get paid some monthly. But we're always over 12%. You go to a bank, you're looking at they're lucky, 3, 5, 7, 10 basis points. There's just no comparison. So I particularly enjoy watching the growth. I watch the moves. I watch the diversification. But DLP has all the bases covered. They seize an opportunity. They do their due diligence. And then they move quickly once it's time to go. If they got a deal, they got a deal. If it's not a good deal, they pass. It's run like a very, very astute business. Any business that's very successful is run.
Round of applause for George, please. Thank you, George. So when we say we buy these apartment communities and provide safe, affordable housing, generally when we buy them, they're often not safe, great communities to live in. And we come in and we add value. So we come in and do real renovations, improve the apartments, improve the community, move out undesirable people out of the community, make it safe, improve the management, and in turn, we're able to increase rents and occupancy and income. So I'm going to show you a couple live examples of some deals that we've done in the last couple years. And while I do so, you're going to see a couple of our team members coming around collecting your raffles, so get those filled out. All right, so this property here, we bought in July of 2017. It's in a town called Brunswick, Georgia. And if you win the vacation tonight and you go down to St. Simon's Island, you can drive past it. It's about 10 minutes away. It was 128 apartment units. And surprisingly, 40 of these apartments were vacant, down, unrentable for 10 years. They hadn't been rented. Completely down to the studs. So we came in and bought this property with a strategy to come and improve the exterior of it, rebrand it, really take it from we call a C property into a B property, get those 40 apartments all renovated so people could move into them, and then turn around and sell the community. This is what those apartments looked like when we bought it. They did leave us some old paint, but otherwise there wasn't much in them. And this is what they look like after we were done. Now, all 40 apartments look like that. Cleaned up the outside. We rebranded it from called Merritt Landing to Live Golden Isles, and put about $1.1 million in improvements, granite style counters, new cabinets, new appliances, nice flooring. This is what it looked like when we finished it, rebranded it, improved the management. So the day we bought it, it was bringing in $53,000 a month in rent. The day we sold it, 2 years later, it was bringing in over $100,000 a month in rent. So we bought it for $5.25 million, and we sold it for $9.75 million, exactly 24 months later, for an annual return of about 30% net to investors. Here's one that we just sold a couple weeks ago. This was in Wilson, North Carolina. We bought this in November of 2017 for $4.6 million. It was 100 apartments. It had high occupancy, but it had some neglect. It needed some freshening up, needed some better management. It had some big exterior needs as well. So we came in and improved up the exterior, replaced all the parking lots, renovated some apartments. We increased the rents up as we put in better resident base, and really drove it through strong management. This is what a lot of the units look like when we came in. We turned them into look like this. So this is, not a higher-end apartment community. So we didn't go in there. You'll notice those are still some of the original counters, some of the original cabinets. We put in some nice backsplash, hard surface floors, fresh paint, and really made the apartments nice and clean and fresh. And so we took the average rent from $640 a month when we bought it to less than 24 months later, to $735. Took the rent from $63,000 to $72,000 a month, and we sold it for $7,050,000. This was in the equity fund too. So 25 months we owned it. We generated an annual return of 69% on this investment. So this helped with the 55% returns we generated last quarter in the equity fund too. This property we sold in December as well. Somewhat similar story. This is in Spartansburg, South Carolina. It's called Village at Willow Lakes. We bought it in February of 2018 for $3.7 million. It was 95 apartments, 84% occupied. So we came in there and tackled a lot of deferred maintenance, replaced roofs, improved the curb appeal, renovated a bunch of apartments. Again, similar story. Really drove up strong management. And this is what all the apartments looked identical to. This is a Cardinal apartment community, which we've owned 10 of these. They're all built exactly the same. This is what we renovated a lot of the apartments to look like. And we sold this property 22 months later we took the rent from $42,000 to $52,000, took the gross revenue, took the average rent from $515 a month to $655, 27% increase. Still very affordable. We sold it for $6.3 million in December of 19, 22 months after we bought it, for a 35% annual net return on this investment. Thank you. And one last one. This was actually one of our earlier apartment communities we bought. This is called Spanish Villas. It was in Daytona Beach, Florida. We bought in 2016 for $2.7 million, 56 apartments. Overall, had high occupancy when we bought it. Really needed strong management. And so we came in there, really, again, drove strong management, cleaned up a lot of the units, improved the tenant base, added a lot of things to make it more efficient in terms of a lot of our expenses, like energy efficiency and things like that. We spent $260,000 on capital expenses. So unlike most of our properties, there wasn't a lot of huge renovations, but we spent the money really wisely. And we sold this property 32 months after we bought it and those stats are actually a little off, I'm seeing, but we sold this property for $4.4 million, which was a 43% annual return over a little under 3 years net to investors. So those are some of the examples of some of the properties we've sold recently. Generally, the properties we buy today are a little bit bigger in terms of number of apartments than these, but the same type of story, same type of strategy. These are some real life examples. So how do we mitigate risk on buying real estate? I'm actually going to skip this due to time, but we can send this out. It'll walk you through in detail our entire acquisition process to how we underwrite properties, how we go out and look at them, walk every apartment, get tons of reporting, send a whole team out there, bring contractors out there, bring engineers out there, evaluate the competing communities, evaluate crime reports, get environmental reports done. I mean, just a ton of work. We take in hundreds of deals a month that we look at, and really at the end of the day, we buy 1 or 2 properties a month that make it through all of our due diligence, and that we're able to buy and generate the kind of returns you just saw. So we're very disciplined in our buying. This is the hottest market ever to buy apartment communities. There's more money going into multifamily apartments than all other real estate asset classes put together. I mean, everybody realizes this is a place to be, especially when the next cycle comes. So getting the kind of returns we generate takes a lot of work, a lot of effort to generate these kind of properties that produce double-digit cash flow. So we're buying properties generally where we're getting over an 8% cap rate, for those of you who are familiar with real estate terminology, which basically means we're paying generally 25, 30% less than market value. We use very conservative assumptions to what's going to happen in the economy, what's going to happen with rent growth, et cetera, to make the investment still make sense that we can hit our return targets to our investors. So with all that said, I'm going to summarize up our investment funds. So first up is the DLP Housing Fund that I touched on at the beginning. This is our new fund that we're rolling out here basically tonight. This fund gives the benefit of really the mix of all of our funds. It provides liquidity. You can get out of the fund throughout the term. You don't have to stay in for 5 or 7 or 8 years like a normal real estate investment. You get monthly distributions. You get tax shelters that come from depreciation, as well as the benefits of it being a REIT, a private REIT, as a 12% targeted annual return. And it invests in everything DLP does. So it gets the benefit of the diversification of everything DLP does in one fund. Here's again the stats once again, 12% overall return, monthly distributions of the 6% preferred return that you earn before we earn anything. We co-invest directly into this fund right with you. We'll be the largest investor in this fund. I'll be the largest investor in this fund. So that's brand new. Love to talk to you about it. If you want to invest in real estate equity, get tax shelters, that's the only fund that we have today that's investing directly in real estate, but also having the diversification of investing in our lending strategy. Or you can invest directly in the lending fund or the income and growth fund that you heard both George and Linda talk about, which are both very similar funds. They both only do direct lending. They both have a targeted return of over 11%. They both drastically have exceeded that return target. They both have a 10% preferred return, which means you earn 10% before we earn anything. They both pay out all their distributions out on a monthly and quarterly basis. So they pay out the preferred return every month, and then the lending fund, all the returns over the preferred return monthly, and the income and growth fund, all the returns over the preferred return quarterly. Doesn't have the tax shelter of the housing fund, but great liquidity. You can redeem out of the fund, which is 90-day notice. So very liquid. You don't have to make any long-term commitment. And the last way you can invest with us, and there's some stats on the fund, which I'm going to move a little quick. Here's the historical returns, 13.97% return since we started this fund 6 years ago, net to investors. And then the last way you can invest with us, which was the first way people could invest with us when we first started, and still one of the most common ways people invest with us, is in our fixed notes. We do these in a couple very similar structures where we provide fixed returns to our investors. So you choose how much money you're going to invest. You choose how long you want to commit, kind of like a CD, how long you want to lock it up. You choose just 90 days, 3 years, or 5 years. Then you'll get a fixed return on your investment ranging from 6% to 10%. That's fixed. That's guaranteed by DLP, not guaranteed by the FDIC, but we're guaranteeing the return, meaning we're obligated to pay you that return. All of our funds have the same case that you can take distributions every month, or you can let the returns compound and grow and get the amazing power of compounding returns. Or like George says, he does a little bit of both. My accounting team loves when I make it really complicated, and I let you structure it lots of different ways, how you want to take your distributions and what you want to do. You can choose, you can change at any time if you want distributions, you want income, or if you want growth, or you want a combination of both. It's a great way to get going with us, get a fixed return, see how we work, and know exactly how much money you're going to have in 6 months, a year, 3 years, et cetera. So to wrap us up here tonight, I'm going to have one more investor. Larry's going to talk to Kareen here, tell you a little bit about her experience, one of our longer-term investors. And then we're going to open it up to questions and do the raffle. So with that said, I'm going to give Larry the mic here, talk with Kareen. Round of applause for Kareen.
Awesome. Let's give Kareen a round of applause. Hey, Kareen, how are you? So, Kareen, we've known each other for quite a while, but I'd love it if you could tell us a little bit more about how you came to know about DLP and how long you've been with us.
Okay. So I actually met DLP at a real estate investment group meeting. I was investing in real estate as a hard money lender. And so when I met DLP, some of the things that you guys were doing was very familiar to what I had already been doing. What really attracted me to what DLP was doing is that I was doing everything one-off, and the risk that I was taking was I was making these really large loans one-off. And so when somebody defaulted on something, I had so much work to do. And what I saw of DLP is that you guys had so much in your portfolios. You were reducing the risks. You were vetting all of your borrowers. And so it was really taking a lot of the risk out of what I was already doing.
Awesome. And so to that point, I mean, you're very astute. You have a lot of experience. What, other than kind of the diversification aspect of things, caused you to invest with DLP, say, versus publicly traded funds or, you know, your traditional kinds of investments?
Well, actually, my background is that I worked in the healthcare industry, and I was a biologist and a statistician by training. And as a statistician, I really like to work the numbers. But as a statistician and working the numbers, I hated the stock market. And so when I really got into all of this was when the stock market started to crash. And so, you know, I kind of got started with all of this when it was really at the worst. And what I saw of real estate is that it was kind of contrarian to what was going on in the gambling of the stock market.
Awesome. Well put. Thank you. So I know that you've invested with a number of different kinds of retirement accounts. So, you know, certainly we can work with both non-qualified or cash accounts as well as IRA kinds of accounts. How has that fit into your overall plan, and how do you use DLP for your retirement investments?
Great. So I actually use DLP in a lot of different ways. First, I do invest in a cash account, and at this point in my life, I'm kind of semi-retired, and so what I do is I use my cash account for that. And when I say I'm semi-retired, I also have a business where I'm a consultant in the healthcare field, and as a consultant in the healthcare field, owning my own company, I have a 401k. And I have a self-directed 401k, and I use my self-directed 401k, instead of investing in the stock market, I invest in DLP. And I also use this to invest with my Roth accounts and my other traditional accounts.
Excellent. So, and that's great. And so in terms of, I know you brought some folks with you tonight, and thank you for that. And so I guess for all the folks that are here tonight, what would be one thing that you would say to them since they're considering investing with us?
Consider where all your risks are right now. Nothing's a sure thing. And how much can you talk to the people that you're already invested in? And how much do you trust them? The one commodity that DLP has over everybody else I invest with is I can pick up a phone, I can talk to people, and the answers that I get make sense, and I trust everything that I hear.
Kareen, we're so thankful and grateful to have you. Thank you so much. Let's all give Kareen a big round of applause. Thank you. Awesome.
All right, awesome. So thank you, Kareen, again. So quick recap here, next steps. So you've heard a lot about us here tonight. Hopefully we've made somewhat of a case for you at least to consider. We don't have any paperwork or here tonight to sign you up. But if this is of interest to you, you can go to our investor portal, which I'm really excited to tell prospective investors and our existing investors that this upcoming week we're launching our new investor portal, which is new and improved from the current portal, which will give you access to all of our historical financials. You can see our balance statements, our income statements, the audits by our independent auditors. You can see the fund reports. So you can do a lot of due diligence on your own, get to know us, look at the actual loans we make, research the addresses. You can do a whole lot of due diligence. And then you can also join us at upcoming events. If you want to come travel to some warmer weather, come to us North Carolina next week, Florida a couple weeks after that. And then for those, also mentioned, for those of you who are in the inner circle, I'm going to give you one more request to come join us, as many of you already signed up. We do these events for we call our inner circle, which are our investors who are basically our biggest advocates. So these are investors who have either referred 3 investors to us or have invested $1 million with us, one or the other. That's who's in our circle. We have over 100 investors in our inner circle, and we do these cool events. This will be our 3rd year in a row going to St. Simon's Island, and we have a great time. So even if you're not in the inner circle yet, and it's something you're interested in coming and do with us, please reach out to Larry, Rich, Bob, or Mike, whoever you deal with, and they'll love to chat with you about that, any of our upcoming events, or just in general, follow up, schedule a one-on-one appointment, whether it be phone or face-to-face, to talk about the investment opportunities. So with that said, we're going to go ahead and do the raffle. Are we ready for the raffle now? So prospective investors here. Oh, we got more coming. This is a current, right? Yes, we're going to have a prospective investor pick here. So, go ahead, sir. All right, I will take that. And before I call your name, you don't have to come up. We'll come out to you. You can stand up, please, though, so we can give you a round of applause, but we'll come out to you then. We have Sue. Can you read that?
Scartelli.
Scartelli. Where is Sue? Oh, back here. All right, so Sue, we'll come over to you. So congrats. And now we will have an existing investor pick the prospective investor who is going to win. So let's come over here. Existing investor here. Do the honor.
Thank you.
All right. So the winner here is Michael Piuzzo. Piuzzo? Michael Piuzzo? Say that right? Anybody? Right, I think so. Piuso. I can read out your phone number instead. I can read that a little easier. Michael? All right, so we're gonna do another one. If Michael comes up, we're gonna give him one as well. But we're gonna choose another person just in case. All right. We have Chris Drada, D-R-D-A. Where's Chris? There you go. All right, awesome, Chris. Congrats. We'll come over to you and spend all the details. Congrats, Chris. Appreciate it. Congrats. All right, everybody. We'll come over to you. Yep. All right, so that's the raffle. So thank you, everybody. Mandy or Larry or somebody will come over to you and connect with you on those details. And now I'm going to open it up to questions. So we got a couple mics here. I'm going to ask a couple of DLP volunteers to come grab these mics. Here's Brian and Tyler. And all you do is raise your hand, and they'll come over to you and ask your questions. So here we go. Wow. We have no takers for questions? That's not possible.
I got one right here. Hang on.
Here's one back here.
I'm on my way.
A year ago, I was here to hear your presentation, and it sounded at that time like you were preparing for a possible downturn in the real estate market. And based on what you're telling me tonight, it sounds like that didn't happen. Can you comment on that, please?
Yeah, great question. So his question, he said about a year ago that I was preparing the group for an impending downturn, And based on what he heard today, it doesn't sound like that's the case. That's a great question. So we've been saying the same thing for probably 5 or 6 years, which is next year the market's going to slow down. We're going to see very modest growth in prices. We're going to finally see supply go up and get more to a normal market. So to give you an idea on a home sale market, a normal market would be there's 6 months worth of homes for sale based on how many homes sell a month. And that's a normal market. That's kind of when prices stay about flat because the supply is as high as the demand. We constantly keep breaking the record for the lowest supply ever. So the fundamentals, the fact that there's just not enough housing supply for the demand, and the fact that a year ago we were expecting to see interest rates go up. And we had that blip at the end of 2018 where we saw rates rise. And we thought that that could finally help kind of slow down the demand a little bit on the for sale side, which would finally level things out. Kind of what all the experts now say is interest rates are going to stay low for at least this year. Nobody knows what will happen after the election, but there's no way they're going to raise rates here anytime soon. So with where the fundamentals are, I'm not saying we're going to have a boom market and we're going to see 8-10% price growth, but we're not going to see prices go down in the average homes in most markets. There's exceptions. You're going to find condo buildings in Miami that there's too many condos in Miami and prices go down. You're going to see issues at places like, there's been some issues in some of the suburbs of Manhattan have had some issues. But the average markets that we invest in, the demand drastically exceeds supply. So we just think it's going to be strong and stable, modest growth in rents, modest growth in home prices, strong demand. And the one thing I'll mention is that based on what happens in politics, or if there, some terroristic event, God forbid, or something to that effect, that can change perception. And that can change what people are willing to pay for properties, but that doesn't change the fundamentals that people need a place to live, and people are going to keep living in our properties and allow us to provide stable income. That's a great question.
Michael, first of all, thank you for tonight and everybody from DLP. My question is, when does it make sense for DLP to maintain an investment property or sell it? What's the criteria there?
Good question. So question was basically how do we decide, and I'm paraphrasing so you can correct me if I'm wrong, but how do we decide if we're going to keep a property and keep managing it or sell it, right? So when we buy a property, apartment community I'm going to talk specifically on, we underwrite it, meaning we model how long we're going to own it for and what it's going to be worth when we sell it and what's going to happen. Always that we're going to own it for 5 or 7 years. So we go in, we assume that we're going to have to own it for 5 or 7 years because we expect there might be some point over that time a blip in the market. So we don't want to assume, hey, we're going to be able to sell this in 2 years or 3 years. So we give ourselves kind of more of a horizon. And then also, when you own a property longer, you have to make a better investment to get as high of returns. To do it over 5 years is much harder than doing it over 1 year to get a 20% return. So it keeps us conservative in how we look at deals. But when we have opportunities where people are willing to pay us what we thought we could sell it for in year 7, in year 2, and we're getting the kind of pricing that that's going to deliver 30, 40, 50% returns, we're generally willing to sell. So that's one big factor, is just how hot the market's been. The other big factor is if you look at what we've been buying here in the last year, it's mainly been apartment communities over 200 units. And a lot of what you saw we sold were apartment communities with less than 200 apartments. And we've learned and found that we can get much better consistency in our cash flow, better overall returns, and bigger properties for a few reasons. At a 300-unit property, I have a full-time property manager, assistant property manager, a leasing agent, a maintenance or a service supervisor, and 2 service technicians. At a 60-unit property, I have 1 manager and 1 maintenance guy. If I lose that manager or the maintenance guy, the property performance plummets. In addition, at a 300-unit property, our budget's bigger, and I can afford to hire a better property manager. I can afford to hire a better supervisor. So I can staff with better people. I can manage better returns and generally just get a better overall return. So we've been selling a lot of our smaller properties that are harder to manage for all those reasons, and focusing on larger deals has been another part of our kind of growth of our strategy. Thank you. All right, back of the room here.
Hey, Don. Bob Wachowski.
Hey, Bob.
Again, thanks to you and your team for helping us sleep at night, making us good returns. Two risk-related questions, if you don't mind. Just got the Equity 2 Fund report for 2019, and it lists that 5 of the 9 units are underperforming. 5 of the 9 units. What does that portend for?
Can you say that again?
The fund report lists that 5 of the 9 assets are underperforming.
Oh, okay.
What does that portend for the fund? And then the second question would be, again, a risk-related question. God forbid that something catastrophic happens to one of the housing units and burns down, let's say.
Yeah.
How do you protect against that in a particular fund?
Great. So I'm going to answer the 2 questions there in reverse order. First, what happens if we have a natural disaster and an apartment building burns down, or we have a hurricane or whatnot, and we lose apartment communities? From a financial standpoint, natural disasters are, frankly, a really good thing from a financial standpoint, because we're buying properties well under replacement cost. So when something happens, we end up getting insurance proceeds that generally cover all, if not more than the cost, but even if they cover the same cost. So as an example, the most common thing that happens is roofs get damaged. Well, on average, roofs on an apartment building are 15 years old. Well, when the roofs get damaged, I have all new roofs. That's an improvement to that property. So we've had lots of fires over the years. Lots, I don't know, 5, 10 of them over, 20,000 apartments. We've had natural disasters, multiple hurricanes that have happened, and we've had trees come down through roofs. We've had hail. We've had all kinds of these things. We've had flooding, and every case came out ahead from an insurance standpoint. Now, from a people standpoint, we've been fortunate. In any of those instances, we've had no injuries. We haven't lost any lives in any of those types of incidents. We haven't had anybody get hurt, neither residents or our employees. And then from our standpoint, managing those types of disasters is not a lot of fun. Prepping for it's a ton of work. Dealing with the aftermath, it's a ton of effort and work. But from a financial standpoint, it works out good. Okay, we have rental coverage, so if apartments can't be rented for a while, the insurance company pays the rent anyway. Things like that. So we're well insured. The first question is, he asked, in the Equity Fund 2, which I'm going to preface that in Q4, the Equity Fund 2 generated a 55% net return to investors. So I'm going to preface that before I answer his question. He said, in the reports, it says 4 or 5 of the properties are underperforming. So we report on each community and say, is it performing, overperforming, underperforming? And so from a performance standpoint, if we're on track to the original budget, is it on track or off track? So we try to be very honest with where we are based on the original plan. But sometimes the reason we're off track and we're saying we're underperforming, meaning we're not collecting as much rent as we initially thought we would at this point, is because we realized there was more opportunity than we originally thought to renovate apartments, to improve the communities. And that's why we're seeing these really big profits on the sale of properties, because we're generally driving up values a lot more than we initially expected, getting higher rent than we initially expected. So from a month-to-month basis, we might have lower operating income, but the overall return of the investments are ending up much higher. So thank you, Bob.
All right, you've done an outstanding job. You've had a very impressive career. What is your biggest real estate mistake you feel you made?
Biggest real estate mistake? Is that what the question was?
That you feel you've made throughout your career so far.
Biggest real estate mistake. I'd say we've done generally a good job of this, but the biggest mistake I say is not moving fast enough in bringing in talent. So we do a lot of hiring. It's the #1 place I spend my time by far is on interviewing. I did 13 interviews this past week, to give you a perspective. And that's a pretty normal week. So I do a lot of interviewing, and the #1 place I spend my time on is on leadership development of the people already in the company. So I spend a lot of one-on-one time and group time. So, at times we've waited longer than I think we should have to bring in the right leaders, to give ownership and accountability to people. And I forced too much on, myself and a lot of our great superhero team members, like some of the people in the room, where they've had to do too much. which has slowed some of the ability to grow and not allowed us to execute as fast as we wanted. So that's really the day-to-day biggest challenge I deal with, is around bringing in, developing great people. We recognize it as most important, but still, naturally we're conscious of not wanting to spend money too soon and hire more talent. So we've sometimes waited too long. That's been really the biggest thing. I'd say if I go back, I would have made some decisions faster, brought on talent quicker, and that would have drove even better returns, to us and to our investments. Thank you. Anybody else? All right. Well, then I'm going to go ahead and adjourn it, because I'm going to be around. Lots of the team members are going to be around to answer one-on-one questions. So thank you, everybody, for the time here tonight. Hope you have a great night. Drive safe, please, and thank you.